Good afternoon. On behalf of the Singapore College of Insurance, my name is Perry Tan. I'm heading the Technical Training Department at Singapore College of Insurance. It is my pleasure to welcome all of you this afternoon to this webinar. The title of this webinar is Beyond War, Property and Business Interruption Insurance in an Era of Geopolitical, Political and Catastrophe Risks. Let me just briefly introduce our speaker for today. Our speaker for today is Mr. Julian Teo. He is a partner at Fenchurch Law Asia Pacific. He's a specialist insurance and reinsurance lawyer with over 20 years post-qualification experience. He has particular expertise in complex property construction and business interruption claims. He has worked on risk in the Asia Pac since 2007, and he has been involved in major regional and global events, including business interruption claims arising from the most recent COVID pandemic. His expertise has been recognized in various legal directories, including the Grace Church Asia Pacific Insurance Law Report and Euromoney's Expert Guide to Insurance and Reinsurance in Singapore. Today's webinar covers Beyond War, Property and Business Interruption Insurance, and this is the synopsis as you can see here, right? Okay, so this is a synopsis that what we're going to cover today. Next slide, please. Now, before we start the webinar proper, there are some related courses you may be interested in. We have a course on underinsurance in property and business interruption insurance, property damage and business interruption claims, as well as business interruption insurance back to fundamentals. Please take note of the dates and times, and at the appropriate time, my colleague will be depositing certain links into the chat for your convenience. Poll time, we will have 3 questions here. This is just to gauge your knowledge and understanding of the related issues. Poll number 1 is shown here. Which of the following do you see as the most significant emerging threat to property and BI insurance today? Okay, all right. I'll give you a few seconds to ponder over it. Just click the best choice that you feel. And later on, we will see the results of the poll. And this is for Julian to have a feel of the audience and for him to make certain comments as he deems fit on the results of the poll. Okay, let's close poll number 1. And let's see the results of poll number 1. Okay, all right. So 45% chose geopolitical conflicts, followed by 35% for climate-related catastrophes. Okay, and the rest you can see here. Let's close this poll. Thank you for participating. Second poll question, please. In your experience, where do the biggest coverage gaps currently exist in property and BI policies? 4 choices shown here: non-damage BI, war and terrorism exclusions, contingent BI, and ambiguous policy wordings. Okay, let's close the poll. Okay, again, thank you for your participation. So, pretty close between the first, in fact, it's even quite evenly spread between all 4. So reflecting a quite varied opinion on this. The 28% cited war and terrorism, followed by NDBI, and then followed by contingent BI. Okay, fantastic. Thank you for participating. The last poll, please. How prepared do you think the insurance market is to handle complex interconnected losses arising from geopolitical and catastrophic risks? 4 options here. Make your choice. Okay, let's close the poll. Let's look at the result. Wow, okay. 47% said moderately prepared, some gaps remain, followed by slightly prepared, right? And of course, the rest is shown here. All right, thank you so much. And let's close the poll. Okay, all right. So I think now I will hand it over to our speaker. So over to you, Julian, and Darren, please operate the slides as requested. Okay, over to you, Julian. Thank you.
Thank you, Perry, and thank you very much to the SCI for the invitation to speak today. And good afternoon, everyone. As Perry mentioned, my name is Julian. I'm a specialist insurance lawyer for coming on to 23 years now. I'm currently working at a firm called Fenchurch Law. We are a UK law firm with a difference. We work only for policyholders and brokers in coverage claims against the insurance market. So that makes us somewhat unique in the marketplace, but that doesn't mean that I see insurers as the enemy. Rather, we are all critical parts of the industry that we all know and love so well. So I was asked to give this talk by the SCI a few weeks ago, just before the US Vice President J.D. Vance went to Pakistan for the first round of peace talks. And we were kind of wondering what the timing of this talk ought to be, because there was a risk that the war would end anytime soon if those talks were successful. Obviously, as it turns out, we are still trapped in this mess. So for better or for worse, the content of this talk is still very relevant, and I'm very grateful to all of you for joining me this afternoon. Next slide, please, Darren. So here's a quick index of what we'll be talking about today. We've dealt with the introduction. I'll talk about sums insured and indemnity periods. In terms of systemic risk, why sums insured and indemnity periods are coming under significant pressure in this war scenario, and obviously in a very similar vein when natural catastrophes happen. So then we look at underinsurance, cost pressures, triggers, delays, and gaps in business interruption. And I'll do a couple of slides on war risks and terrorism. I wasn't going to say too much on those topics, but I see that was quite an area of interest in the poll, so I might spend a few more minutes on that now, if that would make the crowd happy. Okay, so next slide, please, Darren. Thank you. Okay, well, poll results were very interesting. As expected, geopolitical risk came up top, and I think in a way it self-selects for this crowd, because you are obviously here to share about geopolitical risk and to listen to what I have to say. If I was talking about AI, I suspect that AI might have been the number one choice in that poll. But interestingly enough, a survey from our friends at Aon last October found that geopolitical risks were the 9th most significant business risk, according to a survey of risk managers and insurance buyers. Okay, and the word in that article from Aon was it surged into 9th place, which means that it wasn't anywhere in the top 10 before. In that survey, the major risks were cyber risk, obviously, and cyber attacks, climate change, and the advent of artificial intelligence. Those were seen to be the major risks, along with regulatory risks, as perceived by the unpredictability of the Trump administration. Well, obviously, I mean, 6 months is a long time in insurance, clearly. The global landscape is pretty much unrecognizable now than it was back then, geopolitically. Since the survey was done last year, we have had the forceful extraction of Nicolas Maduro from Venezuela in January, and obviously now the US-Israel war on Iran and parts of Lebanon as well. So things have fundamentally changed, and I would say, unfortunately, for the worse. Next slide, please. Next slide, please. So to keep things simple, I will center this talk around a basic property and business interruption wording. And I've had a look at the list, and of attendees, and I do apologize if some of this is a bit basic for some of you, but please bear with me, as I just like to create the narrative and take you all along with me on the ride. So as we may know or should know, your standard property BI wording is divided into two sections. The first section is indemnity for physical damage to property. And the second section of the policy is for loss of profit caused directly by Section 1 damage. Okay, so that's the key there. To get cover for loss of profit, you do need to have damage to insured property. As a side cover, so to speak, there is also increased costs of working, which are really a way for the insurer to assist the insured to fund mitigation measures to reduce the Section 2 BI loss. And of course, there are also extensions which do not rely on a property damage trigger, which I will call loosely contingent business interruption extensions or non-damage BI extensions. Okay, so we will work through this talk is fundamentally a talk about insurance policy coverage. So I will be referring from time to time to sample policy wordings, and I do apologize if it is a bit dry, but for wording geeks like me, I find it quite an enjoyable way to spend a Wednesday afternoon. Next slide, please, Darren. Okay, so first off, Section 1. This is the Section 1 insuring clause that gives you cover for damage to physical property. So for policyholders, this is by far the most important part of the policy, because this is the trigger. If what has happened to you does not fall within the meaning of this clause, then you really don't have a claim under your policy. So the Section 1 insuring clause, in the event of any physical loss, destruction, or damage not otherwise excluded happening at the situation to the property insured described in Section 1, the insurers will, now this is the key part here, subject to the provisions of this policy, including limitations on the insurer's liability, indemnify the insured in accordance with the applicable basis of settlement. That limitation on the insurer's liability is a reference to sums insured and sublimits under the policy. Okay, so please bear that in mind as we work forward. Next slide, please. Section 2 insuring clause. So this is for the business interruption section, usually written on a loss of profits basis in this part of the world. So it says, if the property insured described in Section 1 used by the insured for the business is lost or damaged during the period of insurance, and this loss or damage results in the interruption of or interference with the business, the insurers will pay the insured the amount of loss directly resulting from such interruption or interference during the indemnity period in accordance with the stated basis of settlement. So there are two quantification concepts introduced here. The basis of settlement, okay, which will also include a sum insured, and also the indemnity period. Now, the indemnity period is a limit, but it is a limit based on time. It is not about it's not about dollars and cents. It's about the period of 6 months, 12 months, 18 months. Okay, but let me go into this in a bit more detail in the next slide. Thanks, Darren. So the sum insured, the concept of a sum insured, applies to both sections 1 and 2 of the policy. In short, it is the maximum amount payable by the insurer to the insured under the policy in respect of that section. Okay, I think that's quite self-explanatory. Indemnity period. It is the maximum length of time over which the insurance company, the insurer, is obliged to make payments to cover the loss of profit insured under the policy. And as a concept, this applies only to Section 2. Now, it's an interesting. So again, The indemnity period is a time cap. Okay, if say about a 12-month period, indemnity period, if the damage takes 18 months for me to reinstate and for my business to get back on its feet, those last 6 months, 18 minus 12, I will not get a single cent for the loss of profit during that period. And this is interesting because both the sum insured and the indemnity period are figures set by the insured. Okay, the insured chooses these numbers and says, I want to insure my factory for $5 million, for example. And the broker will take the risk to the market. The insurers will have a look at them and say, okay, I'll take a 20% line on that. And so on and so forth until the risk is fully underwritten. But these numbers are chosen by the insured, the policyholder. Next slide, please, Darren. So what is the issue here? Well, the issue is simply this. These figures are chosen by the policyholder at the start of the policy, the date of inception. Now, in most cases, the policy period will last for a year. What you could end up having is an incident happening on day 345 out of 365, at which point the world may have changed significantly. As I mentioned earlier, when Aon ran that survey in October, that was merely 6 months ago, but things have changed so much since then. So the priorities for a policyholder in October 2025 would be very different to their priority today. Darren, can we go back one slide, please, to the definitions? So for section 1, the sum insured, what it should be is a best estimate for how much it would cost for the policyholder to reinstate the property physically. And that would, in the case of a fire, for example, or a flood or an earthquake, that should include all your things like your machinery, your structure, your equipment, everything else on the premises, okay? And that is a $sign. For section 2, if you want a seamless transition between receiving the insurance payments back to a fully operating business, the indemnity period should be the length of time it takes for you to reinstate the length of time, not the dollars. Dollars are in sum insured. The length of time it takes for you to reinstate the property, plus a ramp up period for your operations to get back to normal. Okay, it is never a case of factory resuming operations on day 1 and immediately all the orders flood in, capacity is fully utilized, you're making a lot of money again. As we all know as business people, that's really not how it works. Okay, there has to be a ramp up period. So for example, if you're a factory, you've been out of commission for 12 months because of an earthquake. Thanks to the grace of your insurers, you've managed to repair your factory, manufacturing has resumed, but it's day 1. Some of your customers may have canceled their contracts. They may have found other suppliers in the meantime, and they will take some time to come back to you while those temporary contracts and supplies get used up. So there is that gap there for you where your results, your financial results, will not be at the same level as they were pre-incident. Okay, and that's the key here. You want the business interruption cover will cover you until your results, your business performance is back to pre-incident levels. So you should build in this ramp-up period to account for that building up of the business book again as well. And same with, say, hospitality, for example, hotels. So for hotels, if you were destroyed by an earthquake, you reopen your doors on day 1, who's coming into your hotel really? Travel is often booked well in advance by customers. Okay, no one's going to say, hey, this hotel just reopened, let's go there on day 1. Highly unlikely. So you need to get the word back out on the street that that your hotel is back in business, and your occupancy will slowly build up, ramp up. If you were, say, at 80-90% before the incident, it might take you, for example, depending on what season you're in, 3 to 4 months as a ramp-up period to get back to that level. So indemnity period, in an ideal world, physical reinstatement length duration plus the ramp-up period. Okay, but these are all, and I hate to say this, but these are all always built on estimates. Okay, no one knows for sure how long things will take, especially when it comes to reconstruction or market conditions in this volatile world. We make these things based on assumptions, but in the last 6 months, we have found that assumptions have proven to be, frankly, wrong. The test for adequacy of your sum insured and indemnity period will come in only when the event happens. And like I said, all the assumptions at that point may prove to be completely upended. I have a question here from Shirley Cruz. Hi, Shirley. Shirley's question, is the maximum limit 6 months or 12 months? Well, I will say this, the minimum limit is 6 months. Sorry, let me rephrase that. As a policyholder, you can choose an indemnity period, usually from a minimum of 6 months to a maximum of, say, 24, 36, 48 months for very long duration policies. But that 6 months is all the insurer has to pay. Okay, so if your interruption goes well beyond 6 months, that's on your risk. The insurer will pay you for 6 months, and the next 3 months you will not receive a cent from the insurer because you didn't pay them the premium for that cover. Okay, thank you, Shirley. Darren, next slide, please. Next slide again. Okay, so and this is the issue here: average clauses. So your policy will have average or underinsurance clauses in both Section 1 and Section 2. The Section 1 average clause reads as follows: if the property covered under this policy shall, at the time of loss, be of greater value than the sum insured, then you, Mr. Policyholder, will be considered as being your own insurer for the difference. Now, what that basically means is that your sum insured is set at the start of the policy year, but at the time of the damage, the cost of reinstatement may have increased by 30 or 40%. Suddenly, your insurance is no longer adequate to fund the reinstatement fully. That means one of three things. Either you have a rich father who can fund your repairs, you have a generous bank who's prepared to lend you that money to complete the reinstatement, or you go out of business. That is how critical this is. Because remember, at this point, you don't have revenue coming into your business. Okay, everything has stopped. You need as much money from your insurers as you can get. Next slide, please. Section 2 average clause. If the sum insured on gross profit is less than the sum produced by applying the rate of gross profit to the annual turnover, the amount that the insurer has to pay you will be proportionally reduced. So again, it's the same effect. Okay, the adequacy, the percentage of what you've insured versus the actual loss, that shortfall is the discount that the insurer is allowed to apply. But what's important here is that it does not apply only to total losses where the sum insured is completely utilized. So if, for example, if I insured my factory for 5 million, but the cost of reinstatement was 10 million, so I'm 50% underinsured. If there was a fire that broke out and burnt half of my factory for 2.5 million damage, I can only claim 1.25 million of that 2.5 million because of that 50% underinsurance shortfall. That is how critical this has become. And as we will see over the next few slides, the issue of the war has really aggravated the question of whether sums insured and indemnity periods are really adequate. Next slide, please. Okay, well done. Next topic. Okay, now the reason why I say that the assumptions have generally proven to be wrong and will be proven to be wrong in incidents in the coming months is because we've grown soft. Okay, I was born in the 80s. I won't tell you when in the 80s I was born, but what we are living through at the moment is quite an extraordinary period in human history in terms of the lack of wars. Okay, this is a time of really, apart from the odd conflict breaking out here and there, almost unprecedented peace. And this peace has been presided over until recently by a relatively responsible single superpower, which has suddenly gone rogue. But the problem with this, and everyone around the world, even in parts as far-flung away as China for the last 40 years, massive development, as you all know. Global wealth and development has been incredibly high over the last few decades because of this peace. With globalization, with the internet, global integration, everyone's coming closer together. But supply chains they did not diversify. Instead, they became rather more concentrated, because now you could, for example, everyone could go to China to get their manufacturing done. Okay? And that means that if something bad happened in China, everything grinds to a standstill. So, and in the same way, the Straits of Hormuz, everyone is now getting that fuel from the Middle East. They're not buying from Russia or anywhere else. It's all Middle Eastern stuff. So when that when that pipeline is shut off, everyone suffers. And inventory systems, we've become just in time, not just in case, because everyone now is trying to save on the cost of upfront capital and the holding costs, the storage costs of inventory that's not being sold. And the reason why that is because you tell yourself, I can import replacement stock at any time I want to. It will take me 20 days to import it from Europe, for argument's sake. Okay, but that relies on the assumption that there will be peace, that the shipping routes are still smooth, and that no one's fighting any wars. Next slide, please. So here are a few examples of what's been happening of late. As we all know, oil and gas prices have spiked up. Filling up your car, filling up your the fuel, the gas at the station is now an expensive exercise, more so than ever. But you can see here quite a few examples of actual real-life knock-on effects, especially when it comes to reconstruction of physical premises for Section 1 property policies, where costs have increased significantly. So you have petroleum-based materials, waterproof membranes, paints and sealants, all gone through the roof. Raw materials like steel and aluminium, where energy costs are a big proportion of that production of their production costs and therefore their price, gone through the roof. Urea fertilizers, same story. Crane hire. Now, you're not going to be rebuilding a large building without your cranes, but crane hire, the price of that has also gone through the roof because of the sheer amount of fuel that these large cranes consume. And obviously, because the price of fuel has gone up, the cost of freight has gone up as well. So now everything's going up. It's feeding into an inflationary spiral, which translates to price increases across the board. Next slide, please. So here's just a quick example of what's been happening. This isn't to do with the with the Iran war. This is to do with the Suez Canal route and the Houthi rebels in Yemen, who have basically shut off the Suez Canal route over the last couple of years. You can see on that brown dotted line, that was the fastest shortcut between Europe and Asia. Okay, and that route would take roughly, I think it was about 28 days. I think someone said it was 28 days. A 28-day journey from Europe to Asia, 8,500 nautical miles. But because that Suez Canal route and the Red Sea route has been cut off by the Houthi rebels, now a lot of shipping has to go around the other way, the blue dotted line, around the Cape of Good Hope in South Africa and across the Indian Ocean into Asia. Now, this trip adds an extra 3,500 nautical miles and about 10 to 14 days to the trip. Okay, you can see where the problem is now. First of all, it's going to consume a lot more fuel, freight prices going up. You're going to consume a lot more man hours in terms of your ship hands on the vessel, because they need to be paid. They need to be paid for the extra 10 to 14 days of work. So that's going to add to your price as well. And the fact that these voyages now take an extra 40% in terms of time means that there's a lot less supply of shipping capacity available in the world, even as demand goes up. So what obviously when that happens, the price of charter and container hire will go up as well. Next slide, please. And it's not this effect of rising prices, inaccessibility, shortages. It's not all about it's not all just about wars, okay? And that's the reason why we called the slides Beyond War. Well, first of all, just in case the war ended before today, but it's also relevant because a large-scale event like a natural catastrophe can produce very much the same effect. So let me share with you a little war story. So when I first moved to Singapore to start my work in insurance law many, many years ago, I was brought over to do work on the tsunami arbitrations. So I acted for a series of hotels which had suffered massive damage during the tsunami. Okay, and as you can imagine, I think in Thailand there were about 330 hotels that suffered very serious damage or were completely destroyed by the tsunami. In the Maldives, I think it was about 1/3 of hotels were damaged and out of commission. Similar number in Sri Lanka as well. So, but you can imagine though, in Thailand alone, 300 hotels suddenly out of action, suffered serious physical damage. What do you think you're going to need? You're going to need builders, bricklayers, plumbers. What you will need raw materials to rebuild. You will need artisans, wood carvers, marble from Italy or wherever you get your marble from, etc., etc. Suddenly, everything is under a very high demand. Everything is in high demand from your competitors. Prices are going to go up. Assume you can get your hands on them in the first place. Because I can tell you now that the Italian marble artisans are not, or the Thai woodworkers, are not suddenly going to ramp up their capacity 500%. This all creates what we call a recovery bottleneck. Okay, the time that you take to recover. So A, you're paying more for the goods. That's a Section 1 issue. The time it takes to recover and to reinstate your premises, that has increased massively as well because of the shortage of labor. And for the loss adjusters in the crowd, I think that there are a few of you, there is also, as you know, a shortage of loss adjusters. Whenever there is a natural catastrophe scenario, they have to fly in loss adjusters from all over the world, from their sister firms and their offices from Australia, China, and wherever else to make up for that manpower shortfall. And of course, no insurance claims will get paid until the adjuster has come in to have a look. So again, that manpower shortage will lead automatically to a delay in recovery. And that is stressing out the indemnity periods under your BI policy. Next slide, please. And again, we've talked about this already. It's the same with manufacturing. If you're relying on heavy machinery, there's a shortage of output, a shortage of inputs and parts, delays in transportation with the freight and everything else. So any shortfall between the indemnity period and the duration of the interruption will now come into very sharp focus. Next slide, please. Okay, triggers, delays, and gaps. All right, so the trigger for BI cover, of course, as we discussed earlier, is damage to Section 1 insured property. This talk wasn't meant to focus on war risks, and there's a simple reason for that, is that most insurance policies, most property policies do contain a war risk exclusion. And it's usually quite comprehensive in the form of the NMA 2819 Lloyd's Market Clause, which excludes war in other scenarios, okay? Now, the fact that the US hasn't sought approval from its Congress to conduct this war may arguably make it an illegal war if you are a lawyer, but I very much doubt that that means that the exclusion doesn't apply, because the wording of NMA 2819 is so comprehensive, it would include also situations of armed conflict and usurped power. And in these situations, what you have in Iran right now, are two sovereign states fighting each other. That's pretty much the common law definition of a war. Okay, so the triggers in BI extensions. But like I said, but that's not always the case. As a policyholder lawyer, what I do is, I mean, as any coverage lawyer, frankly, would have to do, is to read the policy wordings very, very carefully. And you know this, the insurance policies, for better or for worse, are often cut and paste jobs. So you had an underwriter from the 80s who found a nice clause he liked, he puts it in the policy. Someone from the 90s finds one he likes, puts it in the policy. Someone in the 2000s finds one that she likes, puts it in the policy. So what you have is a Frankenstein policy. It's alive, but it doesn't look very good. And sometimes it's not easy to understand what it says. Okay, so in a situation where you have a cut and paste policy, there are always gaps. And the gaps sometimes work in favor of the insurer, sometimes they work in favor of the policyholder. In a situation like this, like for an exclusion, for example, have a look at the exclusion, the wording of the exclusion, and also how it interacts with the other provisions in the policy. So a very obvious example, let's talk about triggers in BI extensions. Denial of excess cover, okay? Denial of excess cover. It may say something along the lines of, notwithstanding any other provision in this policy, the insurer will cover the insured for X. Now, those words, notwithstanding any other provision in the policy, are a godsend for policyholders, because that means that you are free to ignore any exclusions in the policy, including a war risks exclusion. Okay, so it's little things like that. It's that situation where little words like notwithstandings, despite, little words that don't really have any substantive insurance industry meaning, no trade usage meaning, but they can transform entirely the way you look at the policy and arguably what you are allowed, or what you're able to get from that. And again, for these three extensions, oftentimes the trigger will be physical damage. Okay, it's always damage, usually always damage. Supplies extensions, physical damage at the supplier's premises, which stops them from sending you that supply. Denial of access, physical damage to property within a vicinity, say 5 or 10 kilometers of your insured location, which prevents access of customers and so on to your premises. Public authority order, similarly, you have a situation where the government or civil authority makes an order, and sometimes it does relate to the occurrence of damage in the area as well. Next slide, please. But again, it's not always the case, okay? And especially for bespoke wordings. So where you have a very large insured, very large policyholder with a very influential insurance broker, oftentimes the broker will be the one who will be able to craft a manuscript wording to suit the circumstances of this particular insured. And the insurers obviously want to sign up for that because the premium is large. I have seen, for those extensions, the denial of access cover and the public authority order cover, I have seen examples of those covers whereby there was actually no damage requirement at all. So all you needed was a denial of access. So for COVID, for example, you could see, because in COVID, so I was acting for hotels and property owners and shopping mall owners during the COVID pandemic. What you saw was where you have that denial of access cover that doesn't actually require damage. And there was no damage from COVID because COVID was just I can't remember if it was a bacteria or a virus. I think it was a virus, I think, if I recall correctly, but it's not damage, okay? But it allowed the policyholder to claim under that extension and say, look, cover has been denied because of government authority order, no one is able to come to my hotel anymore because everyone had to stay at home. They couldn't come to hotels. No one could travel overseas to stay in these hotels. I have suffered business interruption. The only trigger required was the government authority order. So please, Mr. Insurer, please pay up. And they did. And same goes with the denial of access order. That denial of access was triggered by the government order telling everyone to not go to restaurants and hotels. So again, access to these premises for commercial reasons was denied, and the insurers had to pay up. I have a question here. Our policy has a war exclusion. Are buybacks allowed? Do you have any premium rates as a basis for the computation as a reference for insuring government assets? The answer is, I don't know the answer. I suspect that some insurers might, especially in a marine context. But again, that's a conversation that's best had with your broker, because your broker will have the lines of communication open with all of their insurer contacts, and they will be able to have that conversation. And the same goes with the premium rates as well. Unfortunately, I'm not in the broking line, so unfortunately I can't help you with that. Okay. And the second question: can you please later share samples of words that could interpret as providing cover in war situations? Let me see how I can do that. Okay. But let me get on with the slides. We still have a little bit to cover before we move on to the Q&A. Next slide, please, Darren. Okay. Oh, something's happened here. Okay. So increased cost of working. As I mentioned earlier, this is a way for the insurers to help fund mitigation measures taken by the insured to reduce the loss under Section 2. So have a read of this with me. The loss of gross profit in respect of additional expenditure necessarily and reasonably incurred for the sole purpose of reducing the reduction in turnover, but this additional spend cannot exceed the sum produced by applying the rate of gross profit to the amount of the reduction thereby avoided. So what that means is there's an economic test. Okay, you cannot spend $10,000 to reduce a loss of profit of $5,000 and expect the insurer to pay $10,000. They will pay you $5,000 because that's the limit. Okay, but you cannot claim the full amount. And so I have seen quite a few examples where the policyholder has taken the initiative to mitigate this loss and has taken extraordinary measures, extraordinary in the sense that they are expensive. And then they present the insurer subsequently with this fait accompli and say, Mr. Insurer, I've done this work to reduce your exposure under Section 2. Can you please reimburse me for this? And the problem always is then the insurer gets their forensic accountant into the site, looks into your books, and what happens is that, as I mentioned earlier, you spent $10,000 to accelerate the reinstatement process, but that acceleration has only saved $5,000. So at that point, the insurer says, no, I'm not paying you for that. And that's a lack of communication, if you ask me. Okay, these are problems that can be solved through communication. I think because as soon as the policyholder makes a claim, an adjuster will be assigned to that case, and you will have an adjuster to speak to. You can call the adjuster up and say, look, I want to do this. I want to get my machine from Italy, and I want to fly it over, directly air freighted from Italy to, for argument's sake, Manila, as opposed to having to do the round long trip for 38 days around the Cape of Good Hope. It will take me 3 days instead of 38 days. I will save a month of trading results. So that is the classic example of an ICW. But again, the cost of that freight, chartering the airplane, bringing it back, loading the machine on, bringing it over to your factory, to your premises, and installing it, that is the ICW cost, which you have to measure against the savings against the reduction in the Section 2 loss. Okay, and in times like these, when you have fuel prices going up, everything's going up, the question of the economic test becomes a bit more challenging because, well, the measures that you're taking are now more expensive. So that there is a bit more of a risk that if you've done the air freight charter thing before, it might cost you a lot more money now. And especially now, because people aren't flying over the Middle East anymore, they can't use the Middle East as a transit point. So there might be alternative routes required, price of aviation fuel's gone up, etc., etc. So the economic test has become a fair bit more challenging for policyholders to comply with. But again, I think this is something that can be handled proactively with communication. If you get the quotes from the air freight provider, for example, present it to the adjuster and get the insurer's approval for that in advance, that is something that will save you a ton of headaches further down the track. Okay, the insurer's happy because they get to pay a valid claim. The broker's obviously happy because they've done good. Believe me, when there is a large claim, it will be 7 or 8 aspects. You could be fighting with the insurers on all 8 of them. If you can communicate proactively and reduce them to a couple, it makes that resolution a lot faster, a lot cheaper, and a lot more pleasant. Oh, two more questions as we go along. If a policy has a communicable disease exclusion, would the denial of excess BI extension still be applicable? I assume that you mean it in a COVID scenario. Well, again, depending on the wording of the exclusion, like I said, words like notwithstanding, etc., etc., then it might be, but I would argue that the exclusion would usually trump the denial of excess BI extension. Because if you were going to exclude a phenomenon like disease, you would use those words usually, notwithstanding any other provision, we will not cover anything caused by disease. Okay? And obviously the denial of access, the proximate cause of that is the emergence of that disease. So I would argue in that situation that, generally speaking, the exclusion should, in most cases, trump the extension. But again, like I said, always get someone who's well-versed in policy language to come in and have a look at the wording. Question from Elaine. And thank you all for the questions, guys, by the way. This is really helpful. And it saves you having to listen to my boring, droning voice for an hour. For BI that does not require physical damage, can this be captured under contingent BI, or is it a separate wording? Okay, well, there are some covers like denial of access or the civil authority order that you can buy off the shelf with your policies. Okay, it's not a separate wording. You can pay an extra premium and get these clauses added to the cover. But one thing that you should bear in mind as well is that these extra covers have sublimits. So, for example, if your BI sum insured was $100 million, they might say, all right, denial of access, we will let them have that without the need for damage, but we will cap that recovery at that indemnity at, say, $5 million. Okay? There are some other covers, I think like supplier extensions BI, for example, that are a bit more complicated because there's a lot more due diligence that needs to go into that underwriting. In some cases, those might be the subject of separate wordings, but if you're happy to have just a smaller sublimit, oftentimes you can buy them off the shelf with your standard PDBI policy. Okay, but in the case that I mentioned, though, the denial of access simply said, if access to your premises has been denied or impeded, the insurer will indemnify you for X dollars will indemnify for X dollars, full stop. So again, that was unusual because, as I mentioned earlier, denial of access usually has a property damage trigger for damage in the vicinity. For example, if you were a hotel at the top of a hill and there was only one road going up the mountain, going up the hill to your hotel, say there was an earthquake that basically destroyed the road and there was no way to get to your hotel anymore, but there was no damage to your actual hotel. There was only a damage to the road. That's the classic denial of access situation, where physical damage to property in the vicinity of your property impedes access to your premises. Then you have access to that cover. That's the classic. In that situation I recounted earlier, we didn't have that trigger, but that was quite unusual. Okay, Elaine, I hope that helps to answer your question. Okay, let's move on. Next slide, please. Okay, that's just basically what I spoke about earlier. We don't need to spend any more time on this. Next slide, please. Okay, war exclusions. Lovely. Okay, now, as I mentioned earlier, the standard war risk exclusion is quite comprehensive. I was asked to say something about terrorism because it is still, it's a current topic. And the one thing I think that we need to be very clear about is that the insurance definition of terrorism is not the same as the common man on the streets or woman on the streets definition of terrorism. Okay, we're not talking about Al-Qaeda type, Basque ETA, IRA type terrorism. It is a lot wider. What I've put up on the slide here is a sample wording with a standard definition of terrorism that you see in a lot of policies today. It's an act which could be the use of violence, but not necessarily, of any person acting alone or in connection with anyone, committed for political, religious, ideological, or similar purposes, to influence any government or put the public in fear. Note it says and or put the public in fear. It's not and. So in short, at its most basic, anyone acting alone, not necessarily violently or threatening anyone, who commits an act for a political purpose to influence a government, that activity is considered terrorism for the purposes of this policy. Now, it's quite a scary thought when you think about it, because a lot of activities that you might think of as exercising your right to free speech suddenly fall to be considered under this exclusion. Next slide, please. So I'll share with you some war stories which I dealt with personally in my career. And this is a good example of a compare and contrast. I'm not sure how many of you were around and working in the industry in 1998, but you would recall that was the Asian financial crisis, which racked our region quite badly. So in 1998, there were quite widespread riots in Jakarta and a lot of other places in Indonesia, which led to the downfall of President Suharto. Okay. Now, those riots started because of the devaluation of the rupiah and the increase in the cost of fuel and the cost of food. A lot of these people were desperate people simply trying to feed themselves. In that situation, I would argue that there is no scope for the terrorism exclusion to apply in most cases. Obviously, there may have been some demonstrations towards the end, especially, that were directed towards the overthrow of Suharto, and that is for a naked political purpose, and that would be something that would be considered terrorism for the purposes of a policy. And in 2010, the Thai demonstrations, yellow shirts versus red shirts, again, this was very controversial because I do remember the CEO of Thai Reinsurance Company came out and said that the damage to the shopping malls in Sukhumvit were caused by random rioters and arsonists. which I will say that it did cause some discomfort within the reinsurance market here in Singapore, because to them this was as clear a political clash as you could imagine. You had the red shirts, the Thaksin's populist party, and you had the yellow shirts, who were out there for the royalist faction. So that was clearly political activity, demonstrating and rallying on the streets of Bangkok. So that ought to have fallen for consideration under the terrorism exclusion. Again, Indonesian riots 2025, quite recent. Were they political? Arguably so. And we had in Nepal as well, I think a couple of years ago, what they call the Gen Z revolution. Where, if I recall correctly, that started because the government started cutting off access to the internet and social media for young people. And those rallies started off as a means of trying to get the government to change its mind. And it eventually blossomed into something a lot bigger, and a lot of properties were damaged and burnt and destroyed. So if people made claims under their insurance for that damage, you could end up in a situation where those claims would be dealt with under the terrorism exclusion. Okay, and remember what I said. Darren, back one slide, please. It's here, political purpose. Okay, something that loose and something that we often take for granted could be excluded as being a terrorist offense. Not to say it'll be treated as a criminal terrorist offense, but the claim will be treated as terrorism, as having resulted from terrorism in the claims department of your friendly local insurer. And that's something that we should all think about. But I'm happy to say that there is terrorism right back cover that is quite widely available, that will write back this exact exclusion here. It's a bit more challenging for war risks. The reason for that is that war tends to be a very large-scale event, and oftentimes the insurers don't want to overload their liabilities by underwriting a war scenario. Because if there is a war scenario, you will get many high-value claims, whereas terrorism tends to be a discrete one or two event type happening, where the losses can be within reason. There are freak events, of course, but generally in terms of the financial impact can be quite contained. Q&As. Political risk exclusions. Can you drop me an email? I don't think we have the time for that. We only have 2 minutes left, unfortunately. Okay. Solar panels. Can everyone see these, the Q&As? Or is it just me?
Yes, Julian, I believe they can see it.
That long question. It's a very good one. Again, can I please ask that you drop me an email? Because we are running out of time, and I can't get into the specifics of that. The Indonesian riots, considered under riot, strikes, and malicious damage? Yes, possibly. Absolutely. It's not. It's all about the. But again, we are assuming here that there is cover for riot, strike, and malicious damage. Absolutely, yes. But what it would not be. It would not be excluded for a political purpose. So when we drew the distinction between when we spoke about and dealt with the Thai claims in 2010, the instructive contrast was Indonesia, because that was a pure riot situation which could have been covered, versus the Thai one, which was clearly naked political activity, which ought to be considered under terrorism. Okay. I think that's pretty much. Next slide, please, Darren. I'm not sure how much time we have. Oh my god. Next. So yeah. So one slide back, please, Darren. So factual inquiry. All I was going to say was, when you have masses of people on the streets, the situation is factually fluid. It may have started off as a riot, but you might have people trying to hitch a political bandwagon. Are trying to hitch their flag to that bandwagon and turn it political. Equally, for a bona fide political rally, which is peaceful, you might get hijackers and nihilists wanting to get involved and just destroy stuff because they can, and to steal things, okay, to break into shopping malls or whatever. That's the kind of fluid situation that we need to be wary of. But the key, whether you're on the insurer side or the policyholder side, is that you need a factual inquiry as to what exactly is going on, and try as much as possible to pinpoint what exactly caused the damage to your property, whether it was rioters or whether it was political, and hopefully try and find a route to cover through that factual confusion, which hopefully you can clear up. Okay, Darren, next slide. I think that's the last slide. We will send these slides around to everyone, but please stay in touch. My email address, my LinkedIn are there. Please do feel free to connect with me. Any last minute questions, I'll be happy to take them. I'm not sure how much time we have left though, Perry.
Okay, Julian, we do have a bit of time, no issues. Now, I will say that for those questions which you say send you an email, we will copy it and send it to you, and we will whatever answer that you gave, we will broadcast to all the participants. But there's one last question.
Yeah.
In your experience, will government declaration or non-declaration of an event being a terrorism act override the policy provision?
That's a very good question. And that really depends on the regulatory regime in that country. So, for example, it's not a terrorism example, but I do remember when I was dealing with some Thai claims in the past, we have the Office of the Insurance Commission in Thailand, which does issue guidelines and rulings on certain events and how insurers should handle them. I'm not sure there would be a situation where they would want to override wording specifically, although what they say will be of great influence. Okay, it will be very persuasive. And by which I mean to say, if an insurer decided to pay based on a declaration from the relevant government body, that might very well mean that the insurer will want to pay up because they do not want to cross their own regulator. And that is something that they will need to deal with their reinsurers overseas. And they will need to convince them that that was the right thing to do. And legally, that was the only option they had. But the roundabout answer is it really depends on the regulator in that situation.
Okay.
And the legal force behind their declaration.
All right. Thank you so much, Julian, for sharing your expertise and insights into this very trending topic indeed. Before we close off the session, and before everybody exits this session, there is an evaluation that will be coming up on screen for participants. So I will encourage everybody to complete the evaluation because your feedback is so important. Once again, Julian, thank you. Thank you for sharing your time for this session.
Thank you.
And
Thank you.
thank you everybody. And I will say it's time to say goodbye. But I hope all of you have enjoyed this webinar. Thank you so much. Bye-bye.
Bye, everyone. Thank you.
Bye-bye.